Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of markets, investing, and finance. So, on today's podcast, I'm happy to welcome Ran Aroussi, who's a software programmer, algorithmic trader, and founder of Tradolo. Tradolo.
Tradologics.
Yeah, sorry, I knew I was going to screw that up. So, Ran, thanks for joining the podcast today.
Thank you for having me. It's Tradologics, by the way, but yeah, we'll get through that.
Yeah, I'll put
Thanks
all
for
the
calling.
links. I'll put everything in writing so people can see. But I guess can you tell the audience a little bit more about yourself and your backgrounds, and I guess how you came to founding this company?
Yeah, sure. So most of my I'll back even more than I was planning to. So most of my life I was a programmer. I started programming when I was 13, give or take. I'm 48 now, so that's quite a long time. So this was always a passion of mine. I always liked it, and always made sense to me for some reason. But through my adult life, I was more involved in online advertising, product creation, for quite a lot of years in the edtech space, where part of what I did was to develop exchangers for online media and kind of all sorts of tools that serves millions and millions of users. And at kind of at some point, I had a combination of a forced hiatus due to my daughter's illness, which is all good now, by the way. Plus, I've kind of lost interest a little bit in online advertising and the fact that Google was my unofficial boss when everything related to edtech, and kind of shifted my focus slowly to the financial markets and to trading. This was almost 10 years ago, and I remember when getting started, I came from a very tech savvy industry, and I was expecting that the world of trading would be a lot similar to what we're used to seeing in the movies. There's all sorts of graphs and stats and fast-paced world, but I realized that this is really not the case. A lot of the work is still being done in Excel, and you had to build your own infrastructures, and it's kind of a mess. So I built my own infrastructure. I dabbled a little bit with the kind of manual or discretionary trading, and I very quickly realized this is not for me. I still remember the day that I lost, I think it was close to $3,000. And it was not the amount that I lost, it was the speed of which I lost it. It took like a second. And I realized, you know what, this in a second I can't even react. So I'm not going to even try. And then I kind of moved my focus to be fully automatic. And yeah, I created stuff for myself, released everything that I've created as an open source library, and kind of gained traction from there. To this day, I'm getting like quite a lot of downloads every month. I think it's all right, 500,000 or 600,000 installs every month. And this kind of got me exposed to other pains that people are kind of facing in this financial market. And I wanted to create a platform where I can just focus on on writing the trading strategy and not on the infrastructure layer and not on the coding side of things. When you write a blog today, you don't build a website from scratch. You just focus on writing content. And I wanted to have that same type of experience for traders. Just focus on generating alpha. It's hard enough to come up with good trading ideas. You don't have to add data science and big data and then an infrastructure to the mix. So that's kind of how the idea came to be, of creating a platform that will let you do just that and just gives you the tools, that's like Lego parts, to build your own trading infrastructure that's right for your specific trading style.
Yeah, it's really interesting. So I guess if we step back and how would you define sort of because you mentioned algorithmic trading there, and I guess it's going away from traditional fundamental and just trying to do it yourself and having your own strategy. So I guess how would you define algorithmic trading?
Okay, so I think the main clue is in the second word there, which is trading, and I think we need to differentiate it from investing. When you invest in something, you do it for long term. You invest in your belief in the company, the sector, whatever it is. But when you're trading, you don't really have I don't really have any specific interest in the company that I'm trading or in the cryptocurrency that I'm trading. I don't hold any kind of ideology behind my decision making. It's mostly based on either price action or behavioral, the way the market and people behave, to certain news events, to certain price action, based on volatility. So that's kind of how I look at algorithmic trading. It's essentially, if you want to really not dumb it down, it kind of sounds harsh, but if you really want to simplify it, it's just a set of rules that the computer follows for you. When you do any sort of discretionary trading, and when you kind of starting to learn about this, you read everywhere, you have to have a plan, and stick to it. And the computer it can do a better sticking to the plan than a human than a human can. So that's how I view this.
You think that's the main advantage? I guess, yeah, a lot of the time with training, it's more psychological. And it's actually, as you said, it's like if you're losing lots of money or if you're making lots of money, it's about not making the wrong decision. And that can be a lot of the
Right.
times when people either sacrifice gains or make losses. So do you think that's the main advantage of algorithmic trading? And is there any other advantages that you personally see?
Well, there are several advantages. First, the main advantage, yeah, for me was that I don't have to stare at charts all day and look for the setup, because if the setup is not there and you're not very disciplined, and I admit to be not to be very disciplined, then you start imagining that the setup is there for you, and then you're starting making decisions. You find yourself, hey, I'm sitting here for 4 hours already, nothing happened. Let me try and do something anyway, and that's going to be a huge mistake on your part. So that's kind of the main advantages that I see algorithmic trading, or anything that you can automate or do on a computer. It just frees you of that bad decision making, and that inevitable human intervention that goes into this. But the other really, enormous benefit of algorithmic trading is the fact that you can scale. You can, if you have a good strategy, or you have a good bunch of strategies, somewhat okay strategies that together, they're making a really good one. But if you're the fact that you can scale, that you can have some strategies that only works on, I don't know, during or around Christmas, so you can set it to run in that period. Or if you have a strategy that only works on Wednesday, where they are announcing the oil levels, then you can schedule that as well. And if your straight trading is working, you can spread it out onto multiple brokers, multiple exchanges, without opening more and more charts. And if it's really working well and you want to scale up, then just add a zero to whatever amount of shares that you're buying or selling. So it doesn't require you to have more offices, more people, more. It's just a number in the game. And that's kind of how you should all kind of almost look at it, as just points in a game, rather than rather than real money, because then you can really start losing touch with what's happening.
Yeah, I think that's what one thing that's attracted me, and I guess a lot of people, to investing in trading. It's the scalability. As you said, you don't need any more resources. You don't need to spend any more time. Once you're actually successful at it, it will just scale itself, and you're basically doing the
Right.
same work as long as you've got a successful strategy.
Exactly. And some strategies are not going to be able to scale. I mean, the amount of return on investment you can do with a $10,000 portfolio or a $100,000 account is not going to be as great as what you can do with, let's say, $1 billion. Just you're losing agility, and so it's different. So especially for kind of smaller operation people, and smaller funds that are working with with smaller accounts, and smaller in this area could be like $50 million. That's still considered to be a very small fund, or very small operation. So that's really is a great way for those types of businesses, and people to scale, because it gives them that ability to go in and out of the market almost unnoticed, and really see high returns on investment.
Yeah, because I was looking at your website and I think I was looking at like the different plans, and it was like one of them was like 150,000 trades a month or something, if I'm
Yeah,
not
yeah.
correct. Yeah, and you know that just blew my mind. So I guess is that sort of how it can work, where it's just you're in and out of the
Yeah, I
market
mean,
very quickly.
as an individual without an algorithm, you can never execute 150,000 trades a month. That's just not going to happen. But a computer can. So even if, and a lot of, I'm not that I'm suggesting that a single person can become an HFT firm, but if we look at that type of infrastructure, they're making lots and lots of trades every day for pennies a trade. But it adds up. So yeah, you can either say I believe in Apple or Tesla, whatever it is, and just buy and hold for several years and hoping to make a lot of money. Or you can say, you know what, I don't really care. I can make a fraction of a percent per trade, but I have lots of trades every day. And again, it adds up at the end of the day, and that's just fine.
Yeah, I think a good example is Jim Simons from Renaissance Technology, which is quite a famous investor. And
Right.
I think a lot of his stuff is algorithmic. And, you know, his goal is basically to make it, you know, statistically as basically he's only going to win 50.4% of the time, maybe.
Right.
And the
Right.
more trades you have, the more likely you are to get that outcome, basically.
Exactly. And I find that a lot of time the algorithm should focus less and less on the entry. You can look at the chart, you can find a lot of good entry points. It's just now you just try to figure out when's a good time to exit. So your exit strategy is no less important, if not more important, than the entry. And the risk management. The risk management goes into a lot of things. It's to the position sizing, is to whether or not to invest in a certain market at a certain time. So there's a lot of things that goes into it. The main idea that your algorithm should be focusing on is just make sure that you live to play another day. Because as long as you can keep the lights on, time is your friend. So that's just kind of how you should be looking at it, and not try to make the 100,000% trade, but just make small ones every few minutes if possible, but at least every few days.
Yeah, if you look at, you know, I mentioned Jim Simons there, who's thought of as one of the most successful traders, and he makes a 60% return every year, which
Yeah,
is,
it's
but
amazing.
yeah, which is, it's amazing. But then I guess some people, they want the thousands percent a year, but you just have to think about it and compounding over a long time. It's,
Exactly.
it,
There's a great book, The Men Who Beat the Market, or The Men Who Solved the Markets.
yeah.
It's an amazing book. I really recommend reading it. It's about Jim Simons and his whole career and approach. And you can see it took him a while to be as confident as he is. Even he thought quite a lot of times of intervening with the algo when he had kind of the bad periods of time. But at the end of the day, just if you have a strategy, you have to trust it. You have to set your kind of the catastrophe stop losses in place. Know that, okay, I'm going to sleep now, and tomorrow the worst thing that can happen is that I'm gonna wake up and I'm down 2%, 3%, whatever it is, 10%, whatever it is that you're feeling comfortable with. Try to ignore it. Worst case scenario, and just within those parameters, just let the computer do its thing. Trust your strategy.
Yeah, and he was a math. Yeah, I actually read that book as well over the holidays, and yeah, it's crazy to think, you know, he's a math genius, but it still took him 10 years to actually really figure out and start making those returns. So
Exactly.
it does take a bit of time. So I guess if someone's listening to this podcast and they're like, "Yep, I'm sold. I want to become a algorithmic trader," how would you recommend people get started? I know you've mentioned your platform, but is there sort of any other way that they could, get started?
Yeah, I think that the actual platform, I mean, what we have is not necessarily a trading platform, but rather like a cloud platform that's designed for traders. But I think that is secondary to the idea. You have to first come up with a good trading hypothesis, which is okay. I think that, I don't know, if a stock is down 4 days in a row, I'm expecting it to go up for at least half a day. either reversing or doing some sort of downward slope. It could be a theory, just as simple as that. And now you have to go and test it. So that means that you need to make sure that you have a good simulator. It's called backtesting. You're able to kind of run an what-if scenario. So what if I ran this strategy with those rules? And those rules are a stock has to be down 3 days in a row. I'm buying it in the morning and I'm selling it at the end of the day latest, at the latest. And let's see that with this rule, how would I have performed over the past 10 years, 20 years, 30 years, whatever it is that you're doing. You need to go less and less into the history, the more frequent your trading is. So if you're trading based on a minute level data or an hourly level data, you don't need to test 30 years back of historical data. But if you're trading on a daily strategy, then yeah, you need as much data as possible. It's just to make sure that your results are statistically significant before you can make any decision. So run this back test, and whatever the results are, there's a lot of things that you can learn about how to perform a good back test. But once you have your back test, whatever the results are, you do not go and change a few parameters and run it again, because that's the data mining. That's making sure that you're kind of fitting the parameter to that historical period. So either backtest on a different period every time with different parameters, or on a completely new data set. You cannot just keep changing and mucking about on the same data set. If everything works great and the backtest looks promising, and you're okay with the expected drawdowns that you're going to experience, then now it's just time to make sure that you code it up, you connect to the brokers, and yeah, really get the strategy up and running with a small account. Again, depending on the frequency of the strategy, you can either go live with the larger account within a year or within 2 weeks if you're trading on a second level strategy. So you need to have that statistics as well, and that confidence really shine. It allows you to have to code your strategy in pretty much any language that you want and connect to any broker, and make sure that you have the market data and all the infrastructure that you need in place to do that. But the first thing is make sure that you have that good trading idea and you understand why it's working. So simply testing out gazillion different parameters and finding a good one without being able to explain it, it could work, but it most likely will not work into the future.
Yeah, makes sense. And are there any resources for backtesting that people could use?
Yeah, I would probably start with kind of the world's favorite, the books by Ernie Chan. So he has 3 great books. I actually have them right here, so I can really tell you the exact title. It's yeah, Algorithmic Trading, it's Machine Trading, and Quantitative Trading. The 3 excellent books. I would also recommend Systematic Trading book by Robert Carver. I really liked it. And in terms of online resources, YouTube, online communities, we have a great community. If you go to tradologics.com/community, it will drop you in our Discord server, and you can ask around, and you can consult with people, and you can find great resources. But yeah, that's part of the work, is to make sure that you find something that works for you. Because if I'm having a blast with Forex, it doesn't really mean that you're going to have a blast with Forex or with crypto, whatever it is. So you need really to find your specific niche, frequency that you're comfortable with, a number of assets that you're comfortable with. So it's really about going through an experimentation period if you're just starting out, before landing on something. So you need to be prepared for at least like 3 months of just bombarding yourself with lots of fees, YouTubes, online courses, whatever it may be, and a lot of trial and error with your own coding skills, and just look at charts, try to find a pattern, test it out using code. And then once you kind of gather that information, after 3-4 months, start sift through it and find the thing that that kind of made the most sense to you and looks promising moving forward.
Yeah, that makes sense. I think that's a great way to start. So I'm sure you've talked to a lot of people about algorithmic trading, and some of them might not have great understanding. So, are there any misconceptions that you get quite a lot that people have about it?
It's not a black box. So it's an algorithmic trading. It again, at the simplest form, is just a computer doing whatever it is that you told it to do. It's not going to do anything for you. It's just going to do it faster, and it's going to do it reliably. So it's the fact that you're taking a strategy and just turning it algorithmic doesn't promise anything. Furthermore, there are some caveats that it's very hard for a computer to come up with subjective opinions about stock market. So, like stuff like head and shoulders patterns it's very hard because it's very subjective. What if you are seeing a shoulder? The computer sees numbers, and if you're checking what the slope of a chart, then you need to make sure that you're looking at it at the exact same resolution at the exact same time frame. Otherwise, you're going to look at different things. Just look at the chart and zoom in and zoom out. It looks completely different. So you need to make sure that you're working with very hard data and not with the subjective kind of opinion towards the market, because an algorithm is not going to be very good at that.
Yeah, I guess that could be easy that we have assumptions that we think are straightforward, but a computer doesn't understand that.
Exactly.
Yeah, so it's important for that. So, I guess we've talked about opportunities, we talked about how people can get involved, but is it possible that a retail trader can create an algorithm and make money and I guess compete against high frequency traders, trading organizations, or are those not the people we're competing against?
These are not the people you're competing against. Let's start with that. So yeah, there's absolutely no way, in my opinion, that a retail investor can compete with an HFT firm at their game. You have to come up with your own game. That means that again, do not try to trade on a tick level or in a sub-second level data. You're never going to be the fastest. Even HFTs are never the fastest. It's an ongoing effort on their part to stay fast enough in order for them to trade. So you need to come up with trading strategies that make money based on alpha, not based on speed. So let's start off with that. I would also say that from my experience, when I started, I wanted to see the action. So I started with, tick based bars and then to minute level. And now I'm trading daily charts and I'm very comfortable with that. And there's a lot less action, but it's much more consistent results that I'm seeing. So I would say that really don't try to compete against HFTs. That being said, the retail trader most definitely has an awesome chance, if they have a good trading strategy, to make money, because they have more strategies available to them. As I mentioned, if you're managing a fund with $1 billion, you cannot trade a lot of the strategies that you can trade with a $10,000 account. You're not even in the same game. When you want to buy 10 million stocks of Apple, you have to spread it out over days, and you have to make sure that people don't really notice what you're doing. And whatever it is, that there's a lot of things that you as a retail trader don't really have to care about. If you're buying 10,000 shares of Apple, which is quite a lot, no one would notice or care. So you're not moving the market. You're not making any impact. So yeah, you have a lot more chances of actually getting those 100% a year strategies than pretty much any hedge fund, just because you're smaller. So that makes you more agile.
Yeah, definitely, which is definitely an advantage. So, Ran, thank you so much for your time today and sort of explaining algo trading. So, I guess my last question is, what is one message you'd like people to take away from our conversation?
It's not rocket science. It can be very simple if you break it down into take the problem, break it down into smaller components, and then you can come up with the realization, hey, that my algorithm only has really two important rules and one occasional rule that works better in I know in volatile market. And then in my opinion, you're probably going to have a winner. If you have an algorithm that needs like 25 different if-then rules, I would I would retest it at the very least, if not stay clear.
Yeah, simple is normally better, especially with strategy. So,
Exactly.
Ran, thanks again. If someone wanted to find out more about your work, where would the best places be? So I know you've mentioned the website. Is there anywhere else?
Yeah, I would definitely encourage you guys to come up and test and play around with Tradologics platform and see what we can offer you. Depending on whether or not when you're listening to this podcast, you're either going to sign up to the wait list or the platform. We're launching it right now, so really in the next few weeks. And it's been 2 years of hard work. So yeah, Tradologics. Trade plus logics. That's kind of how you might remember it.com. And I really hope to see you on the platform and in our community as well. Yeah, that would be a great place to start.
Yeah, definitely exciting times ahead for yourself. I'm sure you'll be very busy. So, Ran, I'll put that all in the description below. But yeah, thanks again for your time.
Not a problem. Thank you very much for having me. Pleasure.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.